Most people begin managing money in the same way. They try to reduce unnecessary spending, keep some cash in reserve, and slowly build savings over time. In the beginning, this is absolutely the right approach. If you have no financial cushion, investing should not even be the priority yet. The first priority is stability. The problem appears later when people stay in the saving phase for too long and start expecting savings accounts to create long-term wealth. At first, saving money feels productive because the number in your bank account consistently increases. You feel more responsible, more organized, and less financially exposed. But eventually, many people notice something uncomfortable. Despite years of disciplined saving, their financial position is not changing as much as expected. Their money is growing slowly while the cost of living keeps rising faster than the interest their savings generate. This is where people start realizing that saving and investing are not interchangeable. Saving is designed to preserve money. Investing is designed to grow money. These are two completely different functions. A savings account protects liquidity and provides access to cash when you need it. Investments are intended to increase purchasing power over long periods of time. If all your money stays permanently in low-yield savings, the growth is usually too slow to build meaningful wealth. The issue is not that saving is bad. The issue is that many people never transition beyond it because saving feels emotionally comfortable while investing feels uncertain. Savings accounts do not fluctuate daily. Investments do. And for beginners, that volatility often feels dangerous even when it is completely normal. Most people do not avoid investing because they lack information. They avoid it because they associate investing with loss. The moment money enters the market, people feel like they no longer fully control it. They see headlines about crashes, recessions, inflation, layoffs, and volatility, and they start thinking that investing is only for experts or people willing to take extreme risks. In reality, the bigger issue is usually misunderstanding time horizon. People often look at investing through a short-term lens, even though investing is fundamentally a long-term process. If someone invests money they might need in 3 months, market fluctuations become stressful because short-term volatility now directly affects their personal life. This is one of the main reasons beginners panic during downturns. They are emotionally dependent on money that should not have been invested in the first place. This is why the transition from saving to investing should never happen impulsively. You do not move all your savings into the market overnight. You build financial layers. One layer exists for protection, another exists for growth. Once people understand this separation, investing becomes much less emotionally difficult. An emergency fund is not investment capital. It is financial insurance. Its purpose is stability, not returns. Investment money should be money that can remain untouched for years. When those categories are separated correctly, market volatility becomes easier to tolerate because temporary fluctuations no longer threaten your immediate security. A common pattern among beginners is believing they need a large amount of money before they can start investing. People tell themselves they will begin once they save $10,000, or once they learn more, or once the economy feels safer. In practice, this delay often becomes permanent. The problem is that investing depends heavily on time. Compounding becomes significantly more powerful over long periods, which means delaying the process can be extremely expensive even if the delay feels rational in the moment. Many people imagine wealth as a result of large investment wins, but most long-term wealth is actually built through consistency. Someone investing moderate amounts every month for 20 years will usually outperform someone trying to perfectly time the market with larger amounts later. Regular contributions matter more than occasional aggressive decisions. This is also why beginners often focus on the wrong questions. They spend too much time worrying about finding the perfect stock, predicting crashes, or identifying the next major opportunity. Meanwhile, experienced long-term investors are often focused on something much simpler: continuing to invest consistently, regardless of short-term conditions. The reality is that consistency usually matters more than precision. Most people fail not because they picked bad investments, but because they constantly interrupt the process. They invest emotionally during optimism and stop during uncertainty. Long-term investing requires the opposite behavior. One of the first mistakes beginners make is assuming successful investing must be complicated. They immediately move toward active trading. speculative assets, short term predictions, or highly aggressive strategies because simple investing feels too boring to be effective. But complexity often creates worse decisions. The more variables involved, the more emotional reactions start influencing behavior. Constant monitoring usually increases anxiety, and anxiety tends to produce impulsive decisions. This is why many experienced investors prefer simple, repeatable systems. Broad index funds are one example. Instead of trying to identify individual companies that will outperform the market, index funds spread investments across large sections of the economy. This reduces dependence on any single company and creates diversification automatically. For most people, simple investing strategies are not inferior. In many cases, they are more sustainable precisely because they reduce emotional interference. A strategy only works if a person can realistically maintain it for years. Complicated systems often fail because people abandon them during stressful periods. Long-term investing is usually less dramatic than people expect. It is repetitive. It often feels slow. There are long periods where progress seems minimal, but compounding becomes more visible over time, especially after many years of consistent contributions and reinvestment. One of the most important things new investors need to understand is that volatility is normal. Markets do not grow in straight lines. There will always be periods where prices fall, sometimes aggressively. These periods feel uncomfortable, especially for beginners, because people naturally interpret declines as danger. But temporary declines are not the same thing as permanent loss. Long-term investing assumes that downturns are part of the process. Historically, markets have experienced recessions, crashes, corrections, recoveries, inflation cycles, and political instability many times. Volatility is not evidence that investing stopped working. It is part of how markets function. This is where time horizon becomes critical again. Someone investing for retirement 20 or 30 years in the future should not react to markets the same way as someone needing cash next month. The longer the investment horizon, the less important short-term fluctuations usually become. In fact, long-term investors often continue buying during downturns because lower prices allow regular contributions to purchase more shares. This requires discipline because emotionally, most people want to stop investing precisely when markets feel uncertain. But historically, consistent investing through volatility has often produced stronger long-term outcomes than trying to predict market movements. The transition itself should be gradual and structured. First, build an emergency reserve that can realistically cover unexpected expenses. Without this foundation, investing becomes emotionally unstable because every financial problem creates pressure to withdraw money early. Second, decide how much money must remain accessible and how much can stay invested long term. This separation is important psychologically because it prevents people from treating investment accounts like checking accounts. Third, start small. The goal at the beginning is not maximizing returns. The goal is building familiarity and consistency. Many beginners think investing only becomes meaningful with large amounts of capital, but the habit itself is often more important than the starting amount. Fourth, keep the strategy simple enough to continue during stressful periods. A complicated strategy that collapses emotionally during volatility is less effective than a basic strategy maintained consistently for decades. And finally, stop expecting investing to feel exciting all the time. Long-term investing is often intentionally boring. Most wealth is built slowly through discipline, repetition, and time rather than through dramatic financial decisions. The people who succeed long-term are usually not the people constantly searching for the next opportunity. They are the people capable of remaining consistent while everyone else reacts emotionally to short-term events. Saving money gives you protection against immediate instability. Investing gives you exposure to long-term growth. Both are necessary, but they solve different problems. Without savings, unexpected expenses become crises. Without investing, building long-term wealth becomes significantly harder because cash alone rarely compounds fast enough to outpace inflation and rising living costs over decades. The goal is not choosing one or the other. The goal is understanding when each tool should be used. Savings create security. Investments create expansion. And once people understand that distinction clearly, investing stops feeling like gambling and starts feeling like long-term financial planning.